had a couple clients that had 100+ year amortizations because they didn't increase their payments voluntarily, and they weren't paying off any principal any further. So they were just paying interest, and at times they weren't even covering the interest. They kind of hit that trigger points.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello, and welcome back to the Ottawa Real Estate Podcast. My name is Paul Stevenson. I'm a level 2 mortgage agent, and I'm joined, as always, by David Warren, owner at Referral Mortgages, level 2 mortgage agent. We're back. We're here. David, how are you doing? How's the week? How's the day?
I am good. I'm good. I said as I came back to the office from the lender breakfast presentation that both of us were at, and I said to the ladies in the office here that it feels like it should be Friday, yet it's only a day and a half into the week.
I agree. It does feel that way. And it's even a short week because Friday, basically all the banks, everyone's kind of shut down for Good Friday. So it's a short week, but I agree. Even yesterday night, I was saying to Sandra, I'm like, feels like Thursday or Friday. It doesn't feel like Monday at all. I don't know what happened there, but one thing I'm looking forward to, we got Game 7 tomorrow, David. We've been talking about the Carleton Place Canadians run right now. They're buzzing. We're going to 7. So if you're in town tomorrow, Wednesday night, 7 o'clock, here we go. Game 7 versus Navan.
CP Barn is where you want to be.
Yeah. Other than that, very interesting. Some good takeaways this morning from the breakfast. Some interesting stats. One of the insurers who I won't, they told us not to share the graphs, so I'm just going to share the numbers and not name names. So one of the major insurers in Canada was there, and they were telling us some stats about kind of the average insured borrower. So insured being, well, two things. One, anyone putting less than 20% in Canada, any 20% down payment, their mortgage has to be insured by one of the three major insurers, CMHC, Sagen, or Canada Guarantee. And for anyone putting over 20%, at times lenders still kind of back-end insure the mortgage, which a lot of people aren't aware of. So even though you're not paying the insurance premium, the lender is still kind of insuring that business on the back end. So they were giving us the stats about the average borrower. So for high ratio, being people putting less than 20%, the average down payment was 8.8%, so a 91.2% loan to value. The average credit score, 802, which I actually thought was I guess I wouldn't say I was surprised, but like I would have thought it was maybe in the mid to high 7s, so low 8s was surprising. Average purchase price, $568,000. And average mortgage size, $540,000. And of the property types, 48% were row houses, and 70% had 2 borrowers at least. So I thought that was very interesting. On the other side, low ratio, average loan to value was 50%. So for people that weren't in that kind of insured bucket, 50% loan to value, so 50% down payment, 850 credit score on average. Average purchase price was closer to $700,000 at $695,000, and the average mortgage size was just under $350,000. Property type, 60% singles and single families, and the borrowers, same thing, 64% had at least 2 or more applicants. So anything in there surprise you, Dave, or anything that kind of caught you off? I just thought it was neat to see that graph because those are not numbers we see all the time.
Just for clarity, these are Ottawa. This is an Ottawa profile of borrower, not Canada or Toronto or Vancouver or any other market. So when we're talking about that purchase price and loan size, et cetera, we are specifically talking about Ottawa. So it's not that surprising. I mean, certainly the high ratio buyers are predominantly first-time home buyers. So having that 8.8% down payment, it does, to me, that makes a lot of sense. Most are going in the minimum down available, which is 5% up to a $500,000 purchase price, 10% for every dollar above $500. So it does, if you're purchased at $600, you're having to put down $35,000. So it is slightly higher than that 5%. So I think that kind of is in that range that I would have expected. So that's kind of typical to see. And same with the product type mix of looking to that, the individuals that are first-time homebuyers are high ratio, not as many single units and more on the row and stack towns, things like that, like those lower price points. So that completely, makes a lot of sense to me, for sure. And even on the low ratio, I mean, we're seeing it where a lot of people don't realize. And the reason, when they say loan to value of 50%, this isn't where the average person is putting a big chunk down as a down payment of like 50% down on those purchases. This also encapsulates what are called transfers. So people that are maybe moving from one bank to another on the back end, if it's less than 65% loan to value, you can get best rates. And on the back end, they insure it with the mortgage insurer, even though the client is not paying. It's kind of, seeing that the single families homes making up such a predominant portion of those property types makes a lot of sense there. And same with that loan size. So there's not a whole lot in there that's that surprising. Certainly the credit score of first-time home buyers on the high ratio is of 802 is certainly surprising of being that strong. But overall, when you look at it, they are very strong numbers. And I know the further slides we're going to get into of stats are pretty surprising as far as kind of the strength of borrowers that we have in Ottawa.
Yeah, so one of the other metrics they talked about was in Ontario, like high ratio mortgages. So again, like 20% or less down payment, 90-day plus delinquency rate. So people that are over 90 days late on their are delinquent basically on their mortgage, and it has a graph in basically February 2024, May 24, August 2024, November 2024, and then February of 2025, and pretty consistent. So overall in Ontario, only 0.13%. That was from February 2024. In February 2025, it's 0.17%. And this is overall. This is fixed rate, adjustable rates, variable rates. So the majority of those are actually variable rates, which was, to me, quite surprising. Well, yes and no, I guess, because, those are, the people that had the variable rates that their payments potentially didn't voluntarily increase. I would have assumed the ARMs would have been the ones that had more delinquency because those are automatically adjusted as the rates went up. The variable rates, a lot of people, it was kind of a sticker shock of, we were talking about this before we came on air. Like I had a couple clients that had 100+ year amortizations because they didn't increase their payments voluntarily, and they weren't paying off any principal any further. So they were just paying interest, and at times like negative, they weren't even covering the interest. They kind of hit that trigger point. So 0.55% was the variable rate delinquency, which is half of 1%. Quite high, I think. But overall in Ontario, to be 0.17 is still like, it's an extremely low delinquency rate. And this isn't even defaulting. This is just like they're late right now. It's not like the banks are taking these properties back. It's just they're late. They need to catch up. But that's a very low delinquency rate, in my opinion.
Yeah, certainly this is 90-day plus. So they're 3 months plus. So they're definitely getting into that foreclosure realm.
They're knocking at the door.
They're on the track to foreclosure.
Yeah.
But when we see the headlines and the news of delinquency skyrocketing and this and that, and kind of these fear mongering headlines and clickbait, these are directly from one of the three mortgage default insurers. There's no one else. There's, it's basically, it's spread across these three. And it's 0.17 of their entire book of business at 3 months plus delinquent. That's wild. To your point of the variable versus adjustable, for those that, don't remember or don't know what that difference is, the variable rate mortgages are static payments. So like a TD, an RBC, CIBC, et cetera. Their variable rate mortgages, the payments from when it funded originally on that purchase or on that refinance, those payments stay the same as variable went up. The bank prime went up, rather. The rate went up, but their payments stay static. And it's the amount of principal and interest that adjust within that payment. So a lot of people, what Paul was talking about of hitting that trigger point is that the amount going to principal becomes zero and their payment actually should be voluntarily increased. Whereas on an adjustable rate mortgage, so if we're talking about big banks, Scotia Bank is really the only one where as bank prime increases or decreases, so does the rate and the payments adjust as well. So the interesting fact of this is when looking at it is that in February of 2025, those static payments, which have never changed, have stayed where they're at, is at a 0.55% delinquency rate of 3 months plus. But the people that were incurring the fluctuations of the market and that their default rate is only 0.26, so over half of what the variable static payments have been, which to your point, I think is very interesting because those are, I would thought they would be completely reversed, that those incurring the elevated payments of 10 increases in a row would have been in more trouble than those with static where their payments haven't adjusted whatsoever. So it's pretty interesting. And then conversely, when you're looking at the fixed rate delinquency rates, they haven't really budged. Points on fixed rates in February 2024, 0.09% default rates or delinquency rates of over 3 months. And in February 2025 was 0.12%. So no real change there. And these are for individuals on that fixed rate. So really, obviously, that delinquency number is coming from those that took variable or adjustable rate mortgages. But overall, as an overarching, like, delinquency rates are basically non-existent almost in Canada.
Yeah, and talking specifically about the variable and ARMs. So one of the other charts that we saw that I found was quite interesting was the high ratio mortgage loans and the interest rate by renewal year. So it kind of went, 2025, 26, 27, 28, 29, what the percentage of loans coming up for renewal are as far as like fixed versus variable, and also what that average interest rate is for that type of loan. So what I found the most profound was that in 2027, 43% of mortgages that are renewing that are insured were in a variable rate, or at least a variable or an adjustable. And the average interest rate was 4.21%. In 2028, in contrast, for variable rate and adjustable rates, it's only 7%. So it went from basically 43% of people in 2022 taking variable for these insured type products to the following year when rates started to increase, only 7% now went into adjustable. And the average rate there was 4.34. Whereas the average fixed rate for 2028 maturing is 4.89. So like you still would have had a better rate by going adjustable at that time. But obviously the large majority of people kind of switched to fixed during that 2022-23, the commencement of that increase in the variable rates. So I found that very interesting just to see a chart of like specifically what amount, because we hear of all these, millions of mortgages coming due in the next year or two, but nobody really, like, we don't really see these numbers. We just kind of hear those headlines, but actually getting into the numbers and seeing that 43% of people are in adjustable or variable rates coming due in 2027. I found that very interesting. They have every other year as well, which again, I wish we could share this chart. But 2025, for example, 4% are variable or adjustable, which is insane to me. That's so low. 2026, 29%, 2027, 43%, and then it drops back down to 7% in 2028. So there's kind of that sweet spot in 2022. Oh my gosh, that's a tongue twister. 2021 and 2022, where variable rates were just hard to pass up. Like and the other thing they talked about, sorry to ramble here, was that during that time, this was before the stress test got implemented for variable rates. So previously, not to get too in the weeds, but whenever we're pre-approving someone, we have to add a stress test, what they call the stress test, on top of the contract rate. So if your rate today is 4%, we're qualifying you as if your rate was 6%, just to kind of, to factor in any fluctuations in rate in the future. So during this time, that 21-22 window, for variable or adjustable rates, we were still using 5.25%. Whereas the fixed rate that at that time might have been, let's say 4.28 is what the average is. So we are qualifying fixed rate clients at 6.28, but variable rate clients at 5.25. So people that took variable rates could qualify for larger mortgages, which is also why a lot of people decide to go variable. It's the end of my rant.
No, it's great. I mean, kind of continuing on that trend though of what's coming up for renewal and where people are at. Speaking to Ottawa and where we are from an equity position in people's mortgages as well, where they're at for as they come up for renewal, what options they have. In Ottawa, there's no mortgage in a negative equity position. So we've talked about on this show the stability of the Ottawa market versus many other markets within Canada where they fluctuate can fluctuate dramatically. And we're seeing that in Toronto right now, especially in the condo market. And Ottawa hasn't had that big ebb and flow over history. We've talked about it before, and we've shown the charts of the stats of, how many years since the 50s that we've been in a negative appreciation. But 92% of mortgages in Ottawa are below 65% loan to value. So, that really speaks to how strong the Ottawa market is of, not only appreciating or staying stable as far as, what the values are, but obviously as people continue paying down their principal, and that slow uptick in a appreciation of value plays into that. And, when you compare that to the rest of the province, approximately 93% of loans in Ontario are below 95%. So, we're in Ottawa, 92% are below 65, but in the rest of Ontario, 93% are below 95% loan to
Which
value.
is really surprising because we've been hearing horror stories out of Toronto where, people are buying new builds at 1.4 and they go to close and they're 1.1 and, they're having to come up with that difference. So the fact that 93% of mortgages are below that 95% of the value for the overall mortgage, to me was quite surprising because I thought there'd be at least a few people that put a minimum down payment in the last 5 years and lo and behold, their property decreases in value. But I think, again, at least Ottawa specifically, like this kind of speaks to all the people that think the market's going to crash, like to the stability of the market, that even with these fluctuations in rates, prices, how people qualify, the rates are qualifying at, et cetera, there's still a 93%. Well, I mean, I guess it could be higher, but 93% to me sounds very high for how bad it could be, considering we're essentially in a recession at this point. The fact that 93% of them are under that 95 is a good sign, I think, of the stability of the market.
Yeah, no, agreed. And I mean, kind of with that stability of the market and kind of where things are going, I'm trying to transition this or segue this as much as possible into the Bank of Canada announcement when this comes out on Wednesday the 16th.
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most.
But, we've got a Bank of Canada announcement the 16th. The market right now is factoring a 50-50 whether they will hold steady or decrease bank prime. But we had March's inflationary numbers come out today, and they were lower than expected at 2.3% versus 2.6%, in February. So this is positive news of, kind of pushing for Bank of Canada to be able to decrease because inflation did not tick up. And then we also have the headwinds from tariffs, which can impact the economy, obviously, in a negative fashion. But, the fact that inflation is down is pushing that along, but unemployment is up. So I think there is, that 50-50s right now. I'm not sure what that's changed as of, these figures coming out earlier today on the 15th, kind of, to that of where that inflation is and how that plays in. So I don't know that whether the markets have really adjusted based on that yet. But yeah, I mean, we have an announcement April 16th. There's no announcement in May and then back in June. And so, really, if they don't make it, if they do a pause tomorrow, there won't be a decision until June, which is quite a bit off unless they do what they did had to do during COVID. Tariffs come in, markets really tanking. Back in 2020, COVID came in, market started tanking. And so they had to do emergency drops. I don't foresee that in any capacity, but certainly that's something that's playing in, is that May pause and where tariffs might play a negative role in things. But, I've been listening to a lot of news out of a lot of the border towns where they're already having massive layoffs in the manufacturing and industrial, especially car sector, things like that in Canada of mass layoffs. And so I think that's going to continue trickling. And so I'm sure that'll play into the Bank of Canada's decision tomorrow.
Yeah, good day to be an author when you can just write, well, it's 50-50 and you're right no matter what. Like it's basically a coin toss. So I feel great today. Hey, they're sleeping well tonight.
Oh yeah. No one's going out on a limb yet.
No. I think personally, like I think they're going to drop it a quarter point, but I mean, it's like, I mean, to that point of the 50-50, like the stats are all, every time a new statistic comes out, it's like, oh, 58%, 42%. Like it's a coin toss. Like whether you say nobody knows for sure. If you say for sure, you're lying. Like nobody knows. The only person who knows is Tiff, and Tiff's not letting the cat out of the bag till tomorrow at 9:45. So I think we'll see a quarter point drop, and I think just from an overall, to use your term, overarching economic standpoint, like I think there's still a lot of people that are suffering financially in Canada. Like I said, I believe we're in a recession, even if they haven't announced it as such. The vibe session is certainly gone at this point. And I think that quarter point would give some relief as it has. But, we've seen a bunch of drops recently and it doesn't really move the needle. Before, when the first rate drop, I would say like my phone
buzzing.
started ringing.
It was buzzing.
Yeah, my emails started buzzing. But I think, as it kind of becomes just expected, like nobody, like a quarter point tomorrow, even a half point, which I don't think they would ever do, but even that I don't think is going to move the needle. Like I don't think it's going to make people be like, oh, well, now we have the ability to go out and, go on that family vacation or go buy our new house. Like I don't think it's moving the needle in any way. So to that extent, I think whether it's a quarter point or not, or they hold it, the only thing that's really going to shock the market right now is if it goes up. Like whether it stays the same or goes down, I don't think it's going to change much. But so because of that, I think they will drop it a quarter point just to give some, even if it's fractional, like some relief to Canadians. But who knows?
It takes a long time for any of these changes in, either up or down to ripple through the economy. So yeah, there is like that delay. But to your point, certainly a fear that was out there is that with the Bank of Canada starting, doing multiple drops in a row, even for ourselves in the mortgage industry, we were thinking that people were really going to, kind of rush off the sidelines, which never happened. And, a lot of these different kind of headwinds, to use the phrase I used before, but these headwinds of, elections, provincial and federal, and, a change in the US of, parties and Trump coming in and tariff talk and this and that are really kind of changing that, putting people at pause. So to your point, like a quarter point drop definitely will not move the needle when it comes to real estate. I think certainly it will help people, as it rolls through the economy. It will certainly help individuals with their mortgages and with their unsecured debts. But yeah, it's going to take more than certainly another reduction tomorrow to really move that needle. But yeah, I mean, I guess obviously we'll see. But with this inflationary number coming in and unemployment ticking up last week in the labor market, to me, it is signaling. For me, I'm kind of seeing it as a sign that they will do a decrease based on those. We will find out at 9:45.
It's funny. I asked Grok what the like how many decreases there's been, just to quickly vouch, and it says there's been 8. But technically, there's been 7 because it's actually included. It says April 16th, 25 basis points. Like it's already factoring in the drop tomorrow, which is actually kind of hilarious.
It's hooked into Tiff's brain.
Yeah. So it seems there's been 7. Dave, you had another article that we were chatting about the housing starts.
Mm-hmm. Yeah. So there was another article today, just kind of summarizing and talking about where housing starts, which is new construction, number of units under construction, and they fell by 3.3% last month. We have slid to 214,000 units under construction, which is, significantly below economists' predictions or projections. Their figures were 242,000 that they were expecting. And so this is a huge delta between them. But, I find it's pretty comical when any political parties talking about, a consistent even 250,000, let alone 500,000 units, housing starts, is just impossible. Like for historically where we're at, and to go from where we're at of 214,000 units under construction when we're 30,000 off that mark already. There's got to be beyond massive changes for that to over double,
Mhm.
even in the next 5 years, really. And I just don't see it. And from a labor, from a cost, from demand, really just in the red tape. The demand is there, but the red tape, the cost, with where rates are at, borrowing costs, and delays to actually get shovels in ground, I just don't see it picking
Well,
up.
also that unemployment spiking up, like I wonder what percentage of that, we don't have the numbers, but I wonder what percentage of that is the labor force, right? Like the tradespeople that are actually building these homes, like how many of those people just don't have work right now because there isn't shovels in the
Mhm.
ground, you know? Hard to ramp that up quickly is what I'm saying, like to just get a huge work, like a full labor force and expert tradespeople to build these homes overnight is not, it doesn't work like that. Like it's not going to happen. These people have probably found other professions or have gone into different industries because the work's not there. So, what do they do? How are they expecting to create this labor force that's going to build 500,000 homes, you know?
Yeah, and I mean, right now we've got an increase in tariffs on steel and aluminum, which is obviously used for building houses, regardless of what one of the politicians running was saying. Steel and aluminum are used in all building, and so that has caused, there's layoffs in the welding sector and things like that because the jobs aren't there and they're not expecting them to be there. So I know that there's plenty of articles out there, and a lot of news segments about it, of a lot of these trades, the companies preemptively, like, or proactively actually letting people go so that they could try to find work elsewhere, knowing that their inflow of business has fallen right off. And so they're saying to their employees, like, listen, we are not going to have, like, we don't foresee us having any welding jobs coming in because of where steel is at, and we want to let you, before it becomes really hard in the employment market to find other employment elsewhere, we'll get ahead of this and let you kind of get a head start, which is kind of wild to think about. So yeah, we'll see where how the tariffs, how this changes by political parties, or even leaders of the, if the Liberals get in, and it's just a change in leader, how things kind of change for those housing starts, for actually implementing any plans that are going to ramp that up, while also on the flip side incurring significant increase in costs to steel and aluminum.
Great insights, David. Great insights. How do you feel about getting boosted? Little mood boosts.
You know what? I always like my mood being boosted. Let's
Yeah.
go.
Well,
Let's get a booster.
I got 4 today going outside the box. Number 1, how can you get 4 suits for $1? You buy a deck of cards.
Mm.
Mm,
Mm-hmm.
good deal. Number 2, I just watched a documentary about beavers. It was the best damn show I've ever seen. Gotta love a beaver joke. Number 3, when are holes beautiful? When they're gorgeous.
Wow. Wah wah.
Yeah, I like that one. Last but not least, number 4, why don't programmers like nature? Has too many bugs, David. Too many bugs. Too many bugs.
Wow.
Thank you, everyone, for tuning in today. We are always available. You ever want to chat with us, have a conversation about your mortgage, your real estate goals, give us a hoot, give us a holler. Thank you to our sponsors, Gertin Poirier Avocat Lawyers, Big Insurance in Westboro, and Centum. Thank you all for your support, and thank you everyone for listening. We'll be back next week, Wednesday, 10 a.m. See you soon.
Deuces.